Hello students, welcome to TJ Studio. Myself Professor Mehnaz Kaushar of BBA Commerce Department, standing before you to present on topic that is working capital management. So these are our chapter's objective. First we will going to define what is working capital, then we will see working capital concept, types of working capital, what is the importance of working capital, significance of working capital management, what are the various factors that determine working capital requirements. Then we will see different components of working capital, what working capital cycle is, what working capital requirement forecast is, and exactly what is working capital management. So let's start with our concept. So working capital is amount of fund that is necessary to cover the cost of operating the enterprise. Working capital refers to that part of firm's capital which is required for financing short-term or current assets like cash, short-term marketable securities, debtors and inventories, etc. Funds invested in current assets keep revolving fast and are constantly converted into cash, and this cash flow out again in exchange for other current assets. So working capital is also known as revolving or circulating capital or short-term capital. So in short we can say working capital is the short-term money which is required to carry out all day-to-day activities of the business. Next. Now working capital can be classified into two categories. First one is based on the concept and second one is based on time. So under basis of concept, it can be classified into gross working capital and second one net working capital. On basis of time, it can be classified into two categories. First one is permanent fixed working capital and second one is temporary variable working capital. Again, under permanent, you can classify that working capital into two categories, that is regular and reserve. And under temporary variable, again you can classify it into two categories, that is seasonal and special. So we will see each concept one by one. So the first one is gross working capital. What is gross working capital? It is the capital that is invested in total current assets of the enterprise. Example of current assets are like cash in hand or cash at bank, bills receivable, short-term loans and advances, prepaid expenses, accrued incomes, etc. So gross working capital is the total value of your current assets. When you calculate all the total value of your current assets, you will get gross working capital. Now the next is net working capital. What is net working capital? It means current assets minus current liabilities. This is the basic formula of net working capital. When current assets exceed the current liabilities, the working capital is positive, and negative working capital results when current liabilities are more than current assets. So standard ratio for net working capital is 2:1. It means your current assets must be 2 if your current liability is rupees 1. It means 2:1. When you will get this ratio, it means you are in profit condition. Your organization is in profit. So net working capital means when you deduct your current liabilities from your current assets, you will get net working capital. Now we will see few examples for current liabilities like bills payable, sundry debtors, accrued expenses, bank overdraft, provision for depreciation or taxation, net working capital, etc. So these are the basic examples of current liabilities. Next. Now we will see working capital on the basis of time. As I said, first classification is under permanent or fixed working capital. Okay. So it is the minimum amount which is required to ensure effective utilization of fixed facilities and for maintaining the circulation of current assets. Regular working capital is the capital required to ensure circulation of current assets from cash to inventories, from inventories to receivables and receivables to cash, and it continues. So reserve working capital is the excess amount over the requirement for regular working capital, which may be provided for contingencies, which means any emergencies that may arise at unstated period, such as strike, rise in prices, depression, etc. Okay, next. Now, next classification is on the basis of temporary or variable working capital. So, it is the amount of working capital which is required to meet the seasonal demand and some special exigencies. Exigencies means as per the needs. Okay. So, variable working capital is further classified as seasonal working capital and special working capital. The capital requirement to meet seasonal need of the enterprise is called seasonal working capital, and special working capital is that part of working capital which is required to meet special exigencies such as launching of extensive marketing campaigns or for conducting research, etc. So, it comes under temporary or variable working condition. Next. Now, we will see what is the need of working capital, why working capital is necessary. So, we need working capital to purchase raw material, components, or to purchase spare parts, to pay wages and salary to workers or employees, to incur day-to-day expenses and overhead costs such as fuel, power, electricity, etc. Then to meet selling costs such as packing, advertisement, etc. Then to provide credit facilities to the customers. Then to maintain inventories of raw material, work in progress, stores and spares and finished stock. Okay. So, the amount of working capital needed goes on increasing with growth and expansion of business till it attains maturity. So, working capital is required at every stage of business. Now, significance of working capital management. What is the use of working capital management for any organization? So, in a typical manufacturing firm, current assets exceed 1/2 of total assets. As I told you, if you want to achieve success in your organization, your current assets must be more than your current liabilities. Okay. Next point, excessive level can result in a substandard, that is return on investment. Current liabilities are the principal sources of external financing for small firms. It helps to require continuous day-to-day managerial supervision activities, and working capital management affects the company's risk return and it helps to share price. So, these are the significance of working capital management. Next. Now, how to determine your working capital requirement? So, these are the factors on the basis of which you can determine how much working capital is required to run your business or to run your day-to-day activities of business. So, the first one is nature or the characteristics of business which you are running. Then size of business, it may be small size, medium size or large scale business. Then your production policy, on which scale you are producing your products. So, production policy is must. Then length of production cycle. If your production cycle is for 1 month or more than 6 months, then you need more working capital. But if it is for 1 day, then you need less working capital. So, it depends upon the length of your production cycle. Then your credit policy, from where you have taken credit. Okay. So, it depends upon the credit policy also. Rate of growth of business. Of course, it matters a lot because your working capital depends upon your profitability. So, rate of growth of business is very important. Then price level change. The marketing strategy which you are using for your product, it affect your working capital. So, when your price level change, your working capital also change. So, it depends upon the price level changes. And working capital cycle, how much amount you are keeping to meet your day-to-day expenses. Okay. Next. Now, we will see different components, or we can say very important components of working capital. The first one is current assets. Current assets are those assets which can be easily converted into cash and which are required to meet the day-to-day operation of the business. This is the basic simple meaning of current assets. Now, what are the examples of current assets? It include cash or bank balance, temporary investments, inventory of raw material, stores and spares, work in progress. Work in progress means your production is still in process. It means you are converting your raw material into finished goods. It comes under work in progress. Then finished goods, prepaid expenses means those expenses which you have paid in advance, etc. So these are the basic examples of current assets. Now we will see current liabilities. Current liabilities are those claims of outsider which are expected to mature for payment within an accounting year. Okay, so these include creditor for goods purchased, outstanding expenses, short-term borrowing, advances received. Okay, so these are the basic examples of current liabilities. It means you have to repay that amount to the outsider from where you have taken amount. Okay, so this is the basic meaning of current liabilities. Now, this is the working capital operating cycle, accounts payable and value addition. Now we will see chart that starts with the raw material. Raw material in Hindi we say kacha mal. So raw material is the product which is converted into finished good. So to convert this raw material into finished good, we go through WIP, that is work in progress. Okay, and for that work in progress, you require various overheads like material, labor and selling overhead, factory overhead, etc. So these overheads are included under work in progress. So when you convert your raw material through the process of work in progress, you receive finished goods. Okay, then what you do with finished good? You sell those finished goods in the market. Okay, and then you receive account receivable. It means you will earn profit which can be calculated under accounts receivable and later on which can be converted into cash. So this is the basic operating cycle of working capital. Now next, let's see forecasting or estimation of working capital requirement. Means what are the various factors which need to be considered while estimating working capital requirement. Okay, so we will see each point one by one. The first one is the total cost incurred on material, wages and overheads. Material means the raw material which you have purchased, wages, the amount that you are paying to your labor, and overheads, as I told you, factory overhead is there, advertising overhead is there, office overhead is there. So these are the various overheads. So you need to calculate the total cost which can be incurred on various overheads. Next, the length of time for which raw material remain in store before they are issued to production. Then the length of production cycle or work in progress, that is the time taken for conversion of raw material into finished good. If it is required, for example, if your raw material are in warehouse for longer period of time, of course then you need more working capital. Okay, so here the length of production or the conversion of your finished good, raw material into finished good is mandatory. Now the length of the sales cycle during which finished goods are to be kept awaiting for sales. Next, the average period of credit allowed to customer. If you have paid any amount to your customer, then it will also calculated under working capital requirement. Okay, next is the amount of cash required to pay day-to-day expenses of the business, the amount of cash required for advance payment if any, the average period of credit to be allowed by supplier, or we can say time lag in payment of wages or other overheads. So these are the various factors on which working capital estimation is based. Now you can see pro forma of working capital estimate. This pro forma is related with trading concern. As you can see here, statement of working capital requirement. First, current assets, because as we all know, working capital is current assets minus current liabilities. So first we need to calculate how many current assets we are having. So under current assets, these are the few examples: cash, receivables, stocks, advance payment, which is known as prepaid expenses, etc. Then you have to deduct your current liabilities from your current assets, and your current liabilities can be creditors, lag in payment of expenses, etc. Okay, and when you will deduct your current liabilities from your current assets, you will get your working capital. One more thing is that provision and margin for contingencies. Every organization must keep some amount for contingency. Contingency will be based on your working capital. For example, if your working capital is 1 lakh, then your contingency can be 10% or 20% of that 1 lakh. So when you will add this contingency in your working capital required will be your final solution. Okay, so this format is for trading. Next, now this format is manufacturing concern. Okay, as you can see, statement of working capital requirement. Okay, again you have to put the heading, that is current assets. Under current assets you have to classify stock of raw material, work in progress. Under work in progress you have to write raw material, direct labor, overheads. Then third one is finished goods. Again in under finished good you have to write raw material, direct labor, overheads. Then fourth one is sundry debtors, material, labor, overheads. Then fifth one will be prepaid expenses, means the payment which you have paid in advance. Sixth one is cash at bank or cash in hand. Okay, that you can add. It will come under balance of cash. Or any other item which is remaining under current asset, that you can include. Then you will get the total of your current assets. Then you have to deduct your current liabilities. Okay, same creditors, lag in payment of expenses, outstanding expenses if any, etc. Then you will get working capital, that is current assets minus current liabilities. Again you have to add the margin or provision in that working capital, and then you will get your final answer, that is net working capital required. So this is the format for manufacturing concern. Now, points to be remembered while estimating working capital. This is very important. First one is profit should be ignored while calculating working capital requirement for the following reason. Profit may or may not be used as working capital. Even if it is used, it may be reduced by the amount of income tax, drawings, dividend paid, depreciation, etc. Then calculation of work in progress depends on the degree of completion as regard to material, labor and overhead. However, if nothing is mentioned in the problem, take 100% of the value as work in progress, because in such a case the average period of work in progress must have been calculated as equivalent period of completed units. Third one is calculation of stocks of finished good and debtors should be made at the cost unless otherwise asked in the question. So these are the points which you need to consider or remember while calculating your working capital. Now we will see steps in determination of working capital. First step is identify the various item of current assets and current liabilities which consist in determination of working capital. That is most important. The current assets include inventory of raw material, work in progress, finished goods, sundry debtor, prepaid expenses, desired cash balance, etc. And your current liabilities include creditors for raw materials, stores and consumables, creditors for wages, creditors for expenses, etc. So this is the first step. Second step is to estimate the holding period of each stock item, that is raw material or work in progress and finished good, and estimate the collection period of sundry debtors. Okay? So this is the second step. Now estimate the desired cash balance for meeting the requirement of day-to-day operation. Then estimate the payment deferral period of creditor for raw material. Then estimate the lag in payment of wages and expenses. Till here we covered two steps. Now the third step is determine the raw material, labor and overhead cost per unit. Then determine the operating level. Determine the percentage of conversion cost incurred on work in progress. And fourth one is determine the cost of sale and selling price per unit. Okay. Now next one is fourth step, that is ascertain the value of each item of current assets and current liabilities taking into account which the information which I explained in step 2 and step 3. Okay. Now fifth step is put the values of all current assets and current liabilities in a statement form and ascertain the net working capital, that is current assets minus current liabilities, after adding up the desired cash balance and amount needed for meeting contingency. Okay. Next, now the management of working capital, how you have to manage your working capital. So management of working capital is concerned with the problem that arise in attempting to manage the current assets and the current liabilities and the interrelationship that exists between them. In other words, it refers to all aspects of administration of current assets and current liabilities. So working capital management policy of firm have a great effect on its profitability, liquidity and structural health of the organization. Next, now we will see nature of working capital management. So working capital management policy of a firm have a great effect on its profitability, liquidity and structural health of organization. In this context, evolving capital management is three-dimensional in nature. Dimension 1 is that is concerned with formulation of policies with regard to profitability, risk and liquidity. Dimension 2 is concerned with decision about composition and level of current assets, and decision 3 is concerned with decision about composition and level of current liabilities. Now we will see principles of working capital management. The first principle is principle of risk variation. Second one, principle of cost of capital, then principle of equity position, and the fourth one is principle of maturity of period. So these are the principle. Now we will see each point in detail. The principle of risk variation refers to inability of firm to meet its obligation as and when they become due for payment. Larger investment in current assets with less dependence on short-term borrowings increases liquidity, reduces risk and thereby decreases opportunity for gain or loss. Second point, principle of cost of capital. The various sources of raising working capital finance have different cost of capital and degree of risk involved. Generally, higher the risk, lower is cost, and lower the risk, higher is the cost. A sound working capital management should always try to achieve proper balance between these two. Next is principle of equity position. This principle is concerned with planning the total investment in current assets. So according to this principle, the amount of working capital invested in each component should be more profitable. Next, principle of maturity of payment. This principle is concerned with planning the source of finance for working capital. So according to this principle, a firm should make every effort to relate maturity of payment to its flow of internally generated funds. Next is hedging versus conservative approach. These two approaches are very important under working capital. The hedging approach says that permanent requirements should be financed by long-term sources, while the temporary requirement should be financed by the short-term sources of finance. The conservative approach, on the other hand, says the working capital requirement be financed from long-term sources, and the aggressive approach says that even a part of permanent requirement which may be financed out of short-term funds. Next, so now I will wind up. Now we will see the important points of our PPT. So the term working capital may be used to denote either the gross working capital, which refers to the total value of your current assets, and net working capital, which means current assets minus current liabilities, means the excess of current assets over current liabilities. Next, the working capital requirement for a firm depends upon several factors such as nature of characteristics of business, credit policy, price level changes, business cycle, manufacturing process, production policy of the firm, etc. Next, the working capital need of the firm may be bifurcated into permanent and temporary working capital. The hedging approach says that the permanent required should be financed by long-term source, while the temporary requirement should be financed by the short-term sources of finance. The conservative approach on the other hand says the working capital requirement be financed from short-term sources, and aggressive approach says that even a part of permanent requirement may be financed out of short-term firm. Every firm must monitor the working capital position for the purpose of attaining their goals and objectives. So this was all about working capital. Hope all the points are clear to you. Thank you very much for listening my PPT. Thanks a lot.